Welcome back to another episode of Financial Fortitude. Today we're tackling a big question. Are you down with EWB? That's Extraordinary Wealth Builder for those not in the know.
That's right, Michael. We're diving into what it means to be an extraordinary wealth builder, not just someone who saves, but someone who takes intentional steps to achieve financial greatness.
We'll break down the steps to becoming an EWB, show you how starting early can set you up for massive long-term success, and explain how you can take less risks while still ending up in a better financial position.
The goal here isn't just to save money, it's to become exceptional at it. We'll guide you on balancing short-term, mid-term, and long-term goals while staying laser-focused on what you can control. That's how much you save.
Let's be clear, we weren't designed to be average savers. We were meant to be extraordinary. So are you ready to take the next steps toward building wealth that lasts? Let's get started. Welcome to Financial Fortitude, a podcast for high earners, families, and business owners. We're your hosts, Michael Acosta
and Brady Hemmerly. Each week, we bring purpose-driven financial guidance to you so you can be assured you're on the right path. If you're looking to become an extraordinary wealth builder, let's dive in. Michael, I'm super excited about this episode today because I think that this is a conversation that we have had with every single client that we've ever spoke to.
Absolutely. It's really the cornerstone of all of our conversations and is really something that's important because when it comes to building wealth in the most simplest form, it really starts with just getting really good at saving money. I mean, there's no way around it. That's
where I think most of our clients tend to have their biggest challenges. A lot of times clients approach us with questions like, how do I become a better investor? How do I become a better financial planner? How do I become whatever it is? And most of the conversations that we're having are, well, hey, your biggest challenge or your biggest area for improvement is just becoming a better saver.
Yeah, and there's really no way of sidestepping it or cheating the system. I like to often think about physical wellness. If I want to get chiseled abs or lose 20 pounds, like that's great. That's exciting. I can go do all the different exercises. I can CrossFit. I can do whatever. I can get on different types of trends. However, if I'm not doing the grunt work, which at its core is just being disciplined, having some consistency, eating cleaner, and just putting in the actual hours of training, I'm probably not going to get the results that I want. And it goes back to what you're saying is that most of the folks that we meet with or speak with want to get into the exciting stuff first, which is investing, retirement, and everything else, and completely overlook the basic fundamentals of just getting really good at putting money back on their balance sheet, i.e. saving.
Yeah, so let's talk about what that landscape looks like right now. If you were to think through the individuals that we speak with on a regular basis, where do savings numbers typically come in at?
I'd say it's across the board for us, depending on who we sit down with, right? Everyone's on a different financial journey. But what I like to do, just because of my own personality, is I like to refer to the facts. And it's often statistics that are provided in doing some sort of research. So if we look at October of 2024, per the Bureau of Economic Analysis, the personal savings rate in America was about 4.4%. Okay. And keep in mind, that's 4.4% of disposable income. That's not including your employer match. This is purely what we as Americans are putting back on our balance sheet from our own personal gross earnings.
I think that's the biggest challenge or the biggest hurdle oftentimes that we have to overcome is helping show clients that, hey, that 4.4% type of number is fantastic, right? You already are saving. But for many clients who come to us with these big, exciting goals, hey, I want to retire early. I want to take this big trip. I want to buy this new house. The stark reality is that, hey, that 4.4%, that diet that you're really only doing a day or so out of the week is probably not going to get you those chiseled abs that you were hoping for.
Yeah, you can't outrun or outwork out a poor diet, right? Like it's not feasible for most, if not all. So what does being average actually look like if we look at some of the numbers?
So if we look at the numbers and think through $150,000 annual gross income, that's between either one individual or a family. Those individuals or single individuals getting a 3% raise every year, so they keep making more money, and they're saving 4% over the course of 30 years. Before we even start talking about investing, how much has this person saved over the course of their career up to this point? That number is only $285,000. And in many instances, individuals are asking questions like, hey, will I be able to retire off of $285,000 total? And that's where the big challenges are. Those big, lofty, exciting goals just saving. The average in the United States doesn't get most people there.
No, and another way of looking at that, that's a household or an individual making $150,000 a year, but only putting $6,000 back on their balance sheet year over year for 30 years. And again, like Brady mentioned, that's assuming a 3% raise annually for cost of living and not taking into account an investment journey or some sort of investment or return on our investment, right? So if we're not built to be average or mediocre, if we're built for bigger and greater things, what does it actually mean to be what we often refer to as an EWB or an extraordinary wealth builder?
So I think the big target is going to be saving 15 to 20% of annual, and then in all capital letters, gross income.
Wait, you mean before taxes and employee benefits and everything else? Before it actually hits my bank account, I got to go ahead and calculate the pre-tax amount that I'm going to be saving?
You are absolutely right. When you go out and tell people how much do you actually make before taxes, before insurance, before everything, hey, I make $100,000 a year. Your savings should be based on that number, not the number that ends up in your bank account or not the number that is left after you end up going out and spending money in places that may or may not align with the financial diet plan that you've originally built. Yep.
Got you. And just to make sure I understand, I'm not including my employer's 6% match if I put 6% into my 401k, right?
Absolutely right. Yep, that's 15 to 20% of your gross income personally. The employer or any additional benefits that you get, it doesn't count towards that number. We're working to be extraordinary ourselves, not extraordinary with the help of 5% savings coming from my employer.
And oftentimes individuals will ask us in our meetings, well, why am I not including my employer match? Well, it's because it's not guaranteed. You could get let go. You could change your career path. You could become self-employed. And if that's the case, that match isn't always going to be there. So what we want to do is we want to be able to focus on what we can control and put as much guarantees as possible back onto our balance sheet through our own personal efforts. It's the grit. Like, what are we willing to do? And how are we training ourselves to be able to do more? And so if we use that example of someone or a household making $150,000 a year gross, putting emphasis on the gross, pre-tax, 15 to 20% is going to be a range of annual savings of about $22,500 to $30,000. And again, this is going back onto your balance sheet in some form or fashion across various buckets that we like to refer to as short-term, mid-term, and long-term buckets. And we'll get into the details of what those actually are made up of.
Let's get into the numbers first before jumping into the nitty-gritty of short-term, mid-term, long-term. Michael, we take that same household, same raise scenario, 3% raise, and we're now saving 20% over the course of that 30 years. How does that person end up compared to the original, perhaps cheat day saver that we looked at first?
Yeah, now before I share it, I'm going to need you to brace yourself because you're going to be astonished. So that same scenario, same income, same variables, big difference is how much are we saving? We're saving at EWB rate of 20% of annual gross income. Again, that's $30,000 a year of a gross income of $150,000. This individual ends up with the potential for $1.427 million. That's essentially 5xing their outcome, not taking into account any sort of return on investment. That's life-changing just by being more disciplined and being more committed to paying yourself first at an extraordinary rate as opposed to mediocrity or average.
Yeah, so let's talk through that. If we know becoming an EWB looks like 15 to 20% of gross income, how do individuals get started? Or what are some things to think through in reaching that hurdle or that landmark?
That's a great question because oftentimes when we sit down with folks and we tell them, hey, we want to help you become an extraordinary wealth builder, we're going to start putting 15 to 20% of your annual gross income back onto your balance sheet. You can just see their eyes kind of get big and they move in their chair uneasily more often than not. Now, there are some individuals who are like, hey, let's do this. I'm ready to get going and start training on being a better saver. And so the biggest thing that we start with or that we encourage others to start with if they're going to be doing this on their own is create awareness. How do you create awareness? Through organization. We need to be able to compare inflows versus outflows. How much money is coming in versus what's going out? Also, how much am I already saving today through both discipline and automation? And when we capture savings rates or personal savings rates from the onset of our relationships, it's based on disciplined recurring dollars that are being put on our balance sheet, not one-offs that take place every once in a while. Like we're talking about disciplined saving habits. And we define that as your 1 rep max. No different than if you're doing CrossFit or if you're training, whatever it might be. What is the furthest you can push yourself before you fail from a savings perspective? Once we define that, if it's 10%, if it's 7%, if it's 11%, great. We're going to review that in 90 days, and we're going to create 90-day sprint reviews just to make sure, are we able to push a little bit more now that we've become more optimized and more efficient with our budget? No different than training the muscles that support the exercise that you're going to be maxing out on. Just think about bench or squat or whatever it might be.
So talk a little bit more about when you use the word failure, right? If my 1 rep max is 8% or 10% of my income, what does it look like when I fail at a particular savings moment?
Failure in my mind is proactively moving money from my spending account into my savings account, getting to the end of the month or the end of the quarter and having to pull from my savings account to cover some sort of life event. Okay?
It's essentially pulling the parachute on, hey, I need some more money now because I saved too much or was not able to save enough to pay all of the bills that I have.
Correct. Maybe something came up unexpectedly. Maybe you were already budgeting in the numbers on the year for a trip to Disney. Maybe there were medical bills that came up, whatever it might be. And in my mind, you have to give yourself grace, but it is considered a quote unquote failure, right? Because you're not hitting your target. But the great news is you proactively put the money aside to act, in your words, as a parachute in the event of that emergency. If you did not have those dollars set aside, what would ultimately be the outcome?
It's typically credit card debt is what we see most oftentimes, right?
Exactly. So again, it's a failure, but it's not an extreme failure. It's one of those things where it's like, give yourself some grace. Yeah, we deserve to enjoy our dollars, but let's get back on track. No different than having a cheat day when you're, training for something personally.
So how do clients make this easier then? Because a lot of times we get into conversations where clients compare the inflows and outflows or have some framework of their budget. They try their best at their 1 rep max, and maybe we see a failure as a result, or at least we're getting on the edge of failure. And then clients come back to us and say, you know what? This is a little challenging. I'm not really sure where to go next to get to that EWB level. How do I do it, right? Or where do I go from here?
My favorite thing to implement or recommend is automation. Why do people enjoy investing in their 401ks or their employer-sponsored retirement plan so much? It's because of the automation. It's thoughtless. All you do is enroll, you set up a percentage, and they're going to pull it out every pay period, whether it's 26 pay periods, 24 pay periods, or 12 pay periods, right? You don't have to lift a finger other than enrolling in it. We want to be able to replicate that exact same ecosystem environment for your savings outside of your retirement plans, okay? Couple ways of doing this. One, leveraging multiple direct deposits that your employer offers. Second, you want to make sure that you're establishing different types of accounts. You shouldn't be trying to save in the same account that you live your lifestyle out of. So you want to have a dedicated spending account and a dedicated savings or multiple savings accounts if you're one of those individuals that like to have multiple quote unquote envelopes or buckets for purposes. Consider vacation fund, discretionary spending fund, emergency fund, whatever it might be. You can set those up. My favorite piece of automation is what we like to refer to as a wealth building account, or WBA. This is where you take all the household income, deposit it into a single account, and then you're going to pay yourself a stipend each month based on what your lifestyle needs are, whatever your monthly burn rate is. And typically what we see is a higher probability of success because you're forcefully saving by having all of your money going into the WBA first, and then just only taking out what's needed every 2 weeks or on the 1st and the 15th of each month to cover your lifestyle. And in theory, if we do it right, your WBA, your wealth building account, is going to continue to increase month over month. Now we have dollars that we can start to allocate across the various buckets of your balance sheet, or even be more aggressive with eliminating debt, whatever the priorities are based on your purpose-driven financial plan.
I think the big wins that we see with the WBA most often is in setting up the right organizational structure. It's very easy to make savings the automatic choice, do it without even thinking, and spending then becomes the manual choice. Hey, I have to take action. I have to make an effort to go in and overspend this month, as opposed to, hey, I've automatically saved, I'll just spend whatever's left, right, in my fixed income type of budget that I've built.
It's a matter of having a paradigm shift and going from what we've been programmed to do, which is spend by automation and save through decision. We're trying to do the inverse of that. We want to be able to save through automation and spend by decision.
Yep. So I think the second big component that we've yet to touch on from an EWB standpoint is, you mentioned it very briefly, it's this idea of being purpose-driven, It's one thing to be a fantastic saver. Hey, Michael, I'm now saving on average 20% of my gross income. In most scenarios, what we are sharing with clients is, hey, that's fantastic. But our next question is oftentimes, well, now what? What decisions are we making with those savings? And what is the purpose behind the action that you're taking? Talk to us a little bit more about where to take that purpose and thinking through where that saving should be going.
Yeah, this is going to be what I like to refer to as diversify, diversify, diversify. Step 1 is defining how much you can save. 2, putting it back on your balance sheet. And 3, now it's putting it in the right filing cabinet. Another good analogy would be, hey, let's get the money on the bus and then we'll put it in the right seat after the fact. And so we like to keep things as simple as possible, knowing that there's time and place for complexity. But on the surface level, there's 3 forms of purpose-driven goals that we should be saving for: short-term, mid-term, and long-term. So short-term is very simple. Any sort of goal that these dollars could be used for within the next 12 or less months. Another way of looking at this would be an emergency fund. The purpose of an emergency fund is principal protection and it being there when you need it and being exposed to very little, if any, risk.
It's the parachute.
Absolutely.
We don't want a hole in our parachute or a risk with the parachute.
No, you don't. You don't. That would be terrifying because I'm terrified of heights. But another way of thinking about it, it's the moat around your financial fortress. It's extra layers of protection. And the CFP board recommends for single income household, 6 months worth of emergency fund, dual income household, 3 months worth of emergency fund. And again, if there's an opportunity for higher yields through high yield savings accounts, take advantage of it. But that's not the purpose. So don't get caught up in chasing the highest yield that's available in that current moment. The biggest focus is, are you putting enough in there to protect yourself in the event of an unexpected life event? Because we know life likes to throw curveballs.
So clients now are saving at an EWB clip. They've got a little bit of purpose as to why they're saving. They've filled their moat with water. We have that extra layer of protection. Where do they go next, or what's the next line of thinking?
Yeah, once we've established that short-term bucket or that emergency fund, I like to shift gears and additional efforts into what we call our midterm bucket, aka opportunity fund. These are dollars that are still liquid and still accessible before age 59 and a half without any sort of, pre-withdrawal, pre-distribution penalty. This is a non-retirement investment account, meaning that it can be exposed to greater growth potential as well as some associated risks. This bucket's typically going to have a time horizon of somewhere between about 3 to 5 or plus years. That's when you're expected to start spending down this account more than just one-off withdrawals or one-off distributions. Over time, between our short-term bucket and our midterm bucket, again, true liquidity between these two, we want to try to establish 1 year's worth of income between these two buckets. And from an overall expected return standpoint, again, we're taking on more risk than what we would in our emergency fund or our short-term bucket. Like, that's the purpose, is that we're trying to earn more than what we can in a savings account. So we're not focused on hitting grand slams. We're hitting singles and doubles and getting consistency around returns. Somewhere between, in my mind, a realistic net expected return would be anywhere between about 5 to 8% year over year consistently.
Now, why is it important that clients, after building their short-term financial moat, why is it important that clients focus on their midterm bucket before jumping straight into, hey, I'm going to retire one day type of bucket?
I love this question because it's often overlooked and it's not addressed enough in mainstream media or even on blogs. It's diversification, but access to funds without penalties or unnecessary taxes. And what I mean by that is we will often sit down with someone who's like, hey, I want to retire at age 55. Hey, that's great. That's admirable. I want to help you get there. Let's get there because I want your life to be extraordinary. Now, everything's locked up in a tax-deferred retirement account. They can't access it before age 59 and a half without early withdrawal penalties. So where are we going to draw the funds from to cover your lifestyle? Oh, by the way, Social Security can't be turned on until the earliest of age 62. And if you do that, you're going to get a reduction in your benefit. So the midterm bucket offers multiple purposes. Again, higher potential returns, taking on more accepted risk for a level of reward, but also access to liquidity throughout your entire life between now and the time that you retire, whether it's helping fund your child's education, whether it's buying an investment real estate property, whether it's jump-starting a business for yourself, whether it's changing the HVAC. There's just additional funds that are available for you to leverage that are hopefully growing at a rate that will get you closer to where you want to be financially.
Yeah, I think big picture, a lot of times clients read, hear, see, I have to max my retirement accounts to prepare for the future. In an extraordinary wealth building environment, that certainly could be the best choice of action. But oftentimes, what builds the most financial strength on someone's balance sheet? It's the ability for them to make choices before they retire financially, and having access to that midterm bucket really important.
And the last buckets are what we would call long-term bucket. And this is pretty straightforward because most people are familiar with it. It's any sort of investment account where the time horizon is about 8 to 10 plus years, right? So just think about your Roth IRA, 401k, 403b, traditional IRA, or even just a non-retirement investment account that you're earmarking for long-term, right? Because you don't have to be saving in a retirement account for you to be successfully set up for retirement in the future. The idea here is that we want to just make sure that these are dollars that we don't plan on touching or tapping into unless we absolutely have to before age 59 and a half, which again is when we can tap into our retirement accounts without being hit with an early withdrawal penalty of 10% based on current IRS guidelines and rules. Okay. Now with this account, we're going to lean a little bit further out on the overall growth spectrum. We're going to be a little bit more tilted towards stocks, which is where not only risk comes from, but also greater growth potential. So this is where we're going to try to hit triples and maybe even home runs because we know that we have a longer time horizon to be able to withstand and recapture any sort of losses we might experience through market volatility and market cycles.
So big picture, we've gone through what does it look like to be an extraordinary wealth builder and how much you should be saving, how you should be getting organized and really meal prepping what your savings plan look like. We've discussed why it's important to be purpose-driven. There needs to be a why behind every decision. It makes it way easier to stick to your goals. As we begin to wrap things up, let's, Michael, review that same example that we went through, that same hypothetical client. And now let's add in this idea of putting money to work, being purpose-driven, seeing returns on our investment and how it can really impact.
Yeah, let's do it. Let's walk through it. So like you said, we're going to focus on what we can control in this breakdown of this comparison. So again, what we're ultimately comparing is average versus extraordinary, but we're adding in those market returns. So we have a 30-year time horizon, household or individual earning about $150,000 a year gross, okay, pre-tax. Annual raise is assumed to be around 3% to keep up with cost of living. Now, if we go back to what the average investor is saving, it's about 4.4%. So we're going to use 4%, okay, in this analysis. Now, the first question that we have to ask is, what do we think would be a reasonable annualized return? What do most people tell you when you ask them that in your engagements?
It can go all across the board, but the easiest metric to reference back to is just the S&P 500. What has the market done over the past X number of years? It's typically around 10% a year.
As far as the 10-year average goes, right?
Yes.
So let's use that. And for someone with a 30-year time horizon, they're going to be relatively younger, okay? And so traditionally, advisors might say, hey, you can take on extreme risk because, again, you're going to have time for being able to withstand and recoup any sort of market cycles. Now, that 10% is net of taxes and fees. So if we're trying to net a 10% return, if average fees are around 1.5% to 2%, nationally with advisors, that means that we need to be generating about 11.5% to 12.5% gross returns in the market year over year. Well, in this scenario, the outcome for this average investor ends up being about $1.416 million. That's significantly better, about almost 5 times better than what we illustrated previously of saving about 4% of $150,000 a year, 3% raise over 30 years, closer to less than $300,000.
Yep, 285 all the way to 1.4 million. That's just simply the power of investing early, seeing those compounding returns over time, not going in and robbing ourselves early before that 30-year time horizon. Yep.
Correct. Now, if we look at the extraordinary investor, and again, to be an EWB, an extraordinary wealth builder, we need to be saving somewhere between 15 to 20%. But let's just assume that the rate of return that we use here is 5% net of taxes and fees. So again, advisory fees nationally somewhere between 1.5% and 2%. which means our gross return is going to be somewhere between 6.5% to 7.5%. When we look at the outcome, this extraordinary investor has the potential for a minimum of $2.984 million on their balance sheet. That is crazy in my mind. You're basically doubling what the average investor would ultimately end up with just by being more focused on how much money you put back on your balance sheet as opposed to the balance sheets of others.
Yeah, it's extraordinary because this person has essentially doubled their net worth when it's time to retire, and they've done it with half the risk, half the returns. Now, I'm sure there are conversations that we do have with clients that say, well, what happens if it looks much rosier from a return perspective? But you noted it. We don't know what our return is going to be in the future. We don't know how much our investments are going to compound. But the one thing that we do know on a day-to-day, month-to-month, year-to-year basis is what is my financial diet plan? What is my extraordinary wealth building savings target? It's something that you and I can control every single time we step up to the plate.
Correct. So let's compare the two journeys. One, you have an individual who's hitting a higher savings rate. What does this allow them? The opportunity to take less risk in the market, right? You noted that. It's in the numbers. Now, what does taking less risk actually offer an investor in your mind?
For me, it's just more so an enjoyable ride through their saving and investing years. We don't necessarily find ourselves worrying as much when the markets are up or when the markets are down. We don't find ourselves stressing, hey, when is the right time to consider retiring or do I need to save more? Right? It's just a smoother journey all along the way.
The other thing to consider here is that when comparing these two opportunities, we know that we can't control the markets. So the markets in our mind are designed to go up and to go down. We don't know when they're going to go up. We don't know when they're going to go down. We don't know how long the downs are going to be or how long the ups are going to be. So we need to be able to withstand both. But because we're not focused, like you said, on market returns as a primary variable to our financial success, we're focused on what we can control, which is, again, how much money we save and we put back on our balance sheet. The last thing I'll highlight is that with an average saver, the average saver is going to rely heavily on hope and risk. What I mean by that is they're hoping that the market's going to return the amount that they've calculated or that they think that they need in order to find financial success in the future. They're accepting a certain level of risk, thinking or hoping that it's going to work in their favor. I'll be the first to tell you, hope is not a great strategy in most things that we do in life because it doesn't always require action. Right? And in this scenario, if we want to be extraordinary, we need to take the action of doing the grit work of putting 15 to 20% of our gross income back on our balance sheet as opposed to the balance sheets of others.
Yeah. As we wrap things up, we thank everyone for joining us on today's episode of Financial Fortitude, where we explored what it takes to move from being an average saver to becoming an extraordinary wealth builder. We learned that saving just 4% of your income over the next 30 years barely scratches the surface, while aiming for 15 to 20% can create a life-changing financial difference, even without factoring in investment returns. That's the power of taking control over what you can now.
We broke down the practical steps to get there. First being awareness and organization. Know where your money's going at all times. Also, find your savings 1-rep max and work to increase it gradually through the form of a 90-day sprint, or at least revisiting it every 90 to 180 days to see if you can do a little bit more. Automate, automate, automate. Let technology do the heavy lifting. Make sure that you're setting up something that's both recurring, but also simplified for yourself. And then lastly, diversify your savings across short-term, mid-term, and long-term goals and give them purpose because, again, we want to be purpose-driven with every financial decision that we make so that we can be both efficient and optimized. It's not about relying on hope or chasing risky market returns. It's about building a strong, sustainable savings strategy that sets you up for success, no matter what the market does.
If you enjoyed today's episode, here's how you can support us. Subscribe to stay updated on new episodes, like, share, and leave a review to help others discover the podcast, and reach out to us at www.genesiswealthplanning.com/AMA if you have any questions or want to share your journey to becoming an extraordinary wealth builder. Remember, you weren't designed to be average, you were designed to be extraordinary. Let's keep building your financial fortitude, one smart decision at a time. And thank you again for listening. We'll see you next time.
Are you considering hiring a financial advisor? If so, be sure to listen to episode 1 of Financial Fortitude. In this episode, we discuss the reasons why many people choose to hire a financial advisor and highlight the key qualities you should look for in the financial professional you decide to work with. This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Genesis Wealth Planning LLC, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. All scenarios and names mentioned herein are purely fictional and have been created solely for educational purposes. Any resemblance to existing situations, persons, or fictional characters is coincidental. The information presented should not be used as the basis for any specific investment advice. Michael Acosta and Brady Hammerly are registered representatives and financial advisors of Park Avenue Securities, LLC, PAS. Securities, products, and advisory services offered through Park Avenue Securities, member, FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Consolidated Planning Group, Inc. and Genesis Wealth Planning, LLC are not affiliates or subsidiaries of Park Avenue Securities or Guardian. Michael Acosta's California Insurance License Number 0M50974 and Brady Hammerly's California Insurance License Number 4353077. 6991809.8. Expiration 1226.